It's another business week. Good morning and welcome to Business Morning. I'm Chimeze Obi Iwagu. Barely recovering from the 2016 economic recession, the Nigerian economy slipped into its second recession in 5 years as the economy contracted in the second quarter of 2020 and, of course, third quarter of 2020 by 6.1% and 3.6% each year on year. Now, while this was caused by the severe damage brought by COVID-19 due to movement restrictions, the continued reliance on oil for FX receipts and government revenues, together with poor investment in the healthcare sector, weakened the resilience of the economy. AfriInvest West Africa, one of the leading investment banking firms, in its annual banking sector report for 2020, reviewed the performance of the banking sector, presents the firm's opinion on the direction of the banking sector over the short and long term, while highlighting key risks that could affect performance. In the report, AfriInvest Research explored the wide-reaching implications of poverty on the level of insecurity in the country, stressing the need for improved economic development. The report is titled, "The Insecurity Challenges of Poverty." And joining me now is the Group Managing Director, AfriInvest West Africa, Chioke. Thank you very much, Mr. Chioke, for joining us on the program. It's always a pleasure having you on the program.
Good morning, Chimeze. Delighted to be here.
Good morning. Well, the insecurity challenges of poverty, that's the title of your banking sector report for this year. Why? I would have thought it would have been all about COVID-19 and perhaps its impact on the banking sector.
Thank you for that. I think that when we look at all the issues that happen around COVID-19, yes, they are important and they're relevant and, of course, problems for Nigeria, indeed for the rest of the world. But we also have to recognize that that we have to look at our own problems from our own perspective. Earlier this year, the Nigerian Bureau of Statistics released a report showing that the poverty rate in Nigeria is elevated at 40.1%. This means about 83 million people are very poor. We believe that in an environment with an elevated poverty level such as this, there are huge difficulties that it presents because it becomes a breeding ground for insecurity. And you see wide-scale issues of insecurity across all regions of the country, which is, I think, has actually reached a tipping point. The aftermath of the chaos and destruction that came from the NSAS protests is one example. So that's why we felt it was appropriate to title the report with the insecurity challenges of poverty.
Talking about widespread insecurity, what are these risks? Well, insecurity risks, and their impacts not just on the wider economy, but of course on the banking sector in general.
Yes, I mean, we're all very much aware of the Boko Haram insurgency that continues to rage in the Northeast. The cattle rustling and killings in the Northwest is prevalent. Every other day we hear stories about, incidents there. Header farmer clashes across middle belt of Nigeria. There have been risks of attacks on our oil infrastructure from the south, and kidnappings and robberies are all over the country, as you can see. So this is why it's become quite an issue for anybody looking at investing in Nigeria, starting with domestic investors, before even think about foreigners. Their biggest issue now is, am I secure? I mean, imagine thinking of setting up a large, farming plantation, taking any cash crop. You can think about, oil palm or rice. And your first concern will be, are your people going to be safe? So with this sort of, widespread insecurity, it has impact on investments, on growth, and on job creation, which then further, if those ones are constrained, then further sort of catalyzes more poverty and then leads on to more insecurity. Yeah.
Now, the report stresses the need for improved economic development. How would you rate the fiscal and monetary responses to this crisis so far?
We have seen a muted response, I think, in a way that you saw that the fiscal response was something like 500 billion naira. That is small because it only represents 0.4% of GDP compared to, say, South Africa, where they did almost 7% of GDP. The response in itself, from a fiscal point of view, was not sufficient. There are only 1.2 million people have been registered in the social register. Meanwhile, we have, at least based on the government records, 20 million households that are considered poor. So that is small. From the monetary side, you recall that the CBN had announced intervention funds of 50 billion for household and SMEs, 100 billion for healthcare sector, and 1 trillion for manufacturing sector. Yes, those were the announcements, but we felt that the intervention to households and SMEs is quite tiny, compared to the size of the Nigerian GDP. And you know that SMEs represent the largest size of employment within the Nigerian economy. Elsewhere, if you look at disbursements that have been happening to the healthcare sector and the manufacturing sector, it's been quite slow. And other things like the issues around the foreign exchange environment, the devaluation of the official currency, trade problems are also actually hurting those same people in healthcare and in manufacturing. So I would say at best, the response from the fiscal and monetary side has been muted.
Now, you have frequently mentioned structural reforms that are lacking, but in the past year, we have seen some progress. Which of these reforms inspire confidence, and what more do you think should be done?
Yes, it's quite encouraging. I think we saw the government has come out with the increase in VAT, and also measures in the Finance Act to simplify tax payments and reduce the cost of compliance. Those are all very well and good. Also, we've seen the removal of petroleum subsidies and the adjustment of electricity tariffs, which will help the government to retain more of its revenues rather than having to use that to subsidize consumption. All very well and good. But the problem we see is that while we recognize that our revenues are going down, our costs, particularly our recurrent expenditure, has not been going down. Indeed, on the other hand, it's been going up astronomically. We see that when you adjust the government budget for the actual revenue earned and not the revenue they are projecting in any particular year. Take 2020, for example. The recurrent expenditure of government is now about 120% of their actual revenue. That means the government is spending much more than they've earned to maintain themselves before you then talk about putting money for investments in capital expenditure around the country. And that is really a really worrying sign. So something needs to be done about that. And for government to do that kind of expenditure, they are going around borrowing. And then when you actually adjust the debt service to revenue, again, based on actual revenue, we're now coming to about 85% debt service to revenue. Again, very, very troublesome. So there's need for serious improvement in areas like, building stronger institutions, human capital development areas, education and healthcare. Of course, oil and gas sector reforms, we've been waiting for that for ages, and more reforms in the power sector. Transportation is in dire need of support, and anything that we can do to boost competitiveness, which is really removing more government interference in the way business is done. But last but not the least, probably the most important today is security. What we are doing about security in the country that has serious implications for the journey.
Now, I would love you to share your insights on the performance of the banking sector in 2020. The past 1 year has been eventful for banks, as we saw a number of directives from the CBN, especially around credit creation. Now, what are your expectations for profitability in the sector in 2020?
We are expecting that profits will be kind of flat this year for the banks. As a universe of what we've been seeing, we saw that as at half year 2020, Tier 1 banks had expanded their gross earnings by 2.2 trillion naira, just a 5.5% growth. Tier 2 banks have seen their own gross earnings go to 540 billion naira, just 4% growth. So there's weakness in the growth of gross earnings, and this is due potentially partly due to the low interest rate environment. Obviously, the directive by CBN to force banks to expand their loan books has helped in credit creation. We've seen credit grow by 7.4% this year, and again, when compared to last year, that is helpful. But the low interest rate environment, CBN has also affected the banks, particularly from a net interest income perspective. Savings deposits now, banks are allowed to pay only 10% of MPR on savings against the 30% of MPR they used to pay. So that has, helped to increase their net interest income. But on the cost side, we see efficiency issues. Tier 2 banks have seen an improvement in average cost-to-income ratio. They're down to 71% from 74%. But Tier 1 banks have suffered a deterioration. And we see that trending worrying 62% from about 61% last year. So all of these things are coming to the year thinking that the banks have completed this year, profitability will be challenged. And if it keeps flat at the numbers for 2019, then in real terms, they've lost money because the exchange rate has moved from official rate of 305 in 2019 to now about 390 in 2020.
Now, one of the most significant policies of the CBN last year is the introduction of a minimum loan-to-deposit ratio of about 65%. 1 year later, how will you measure the impact of this policy?
It is helpful, but also it's also a complicated policy. On one hand, we're in the middle of a recession. We're suffering the aftermath of COVID-19 and its implications for businesses. So, this is a much more difficult environment even for businesses that have weathered the storm of the pandemic to grow. But on the other hand, you have a policy from the apex regulator insisting that you expand credit to the real sector. So banks have complied. We've seen credit expansion has happened. The current amount of credit in the whole economy is about 59 trillion. But so this has also had an effect because there's much more weakness in the liquidity ratio of banks. Tier 1 banks, I think their liquidity ratio fall from 46% to 43%. But the average loan-to-deposit ratio for all the banks have also improved. So there's more credit. The only problem we have to see is that by next year, you may see more non-performing loans coming out. And then this will also create problems for the banks and the those loans, given in a difficult macroeconomic environment, such as.
Now, one of the major issues for banks have been around maintaining asset quality. How healthy is the loan book of banks?
That's a good point. We see the NPL ratio, non-performing loan ratio, has become elevated. It's now at 6.5%. The industry threshold is 5%. But Tier 2 banks are low at 4.5%. The Tier 1 banks are the ones that are above it. We suspect that the regulatory forbearance and COVID-19 is part of the primary driver of stability in NPLs. We worry that banks have to be cautious in lending, but at the same time, they have to comply with the central bank. So I think that the bigger issue is that if you want to unlock credit opportunity in the country, you really need to think of how you improve the overall macroeconomic environment. And you have to continue to improve on the ease of doing business because those have bigger implications to companies than just the cost of loans, to them. And so we need to kind of take all of this into perspective. But yes, NPL ratios are elevated today, and for the Tier 1 banks, they are above the CBN benchmark of 5% at the uppermost.
Now, across the world, we have seen capital adequacy for banks come under pressure amid COVID-19, with some countries mandating the suspension of dividend payments to support capital levels. How are Nigerian banks positioned?
I think Nigerian banks are doing well. They've remained resilient. Profitability, like I said, is positive. They're tracking on profit, although they are going to be flat relative to 2019. Indeed, the CBN has also put in measures, in place for capital accumulation for the banks that are struggling. So that is one. But Tier 1 banks, we see average capital adequacy ratio of 19.5% as of half year this year. Tier 2 banks are at 17.5% as of half year this year. Both groups are above the minimum requirement of 10% for national banks and 15% for international banks. So, national, that's national banks with national licenses and 15% for banks with international licenses. So, indeed, our Nigerian banks are doing quite well in terms of having sufficient capital to do their business.
So what can you say about the current valuation of Nigerian banks?
Well, that's a good question. You know that the markets have rallied consistently since about March, April this year. And I think year to date, Nigerian capital market is up about 30%. And some people have been asking me a question as, is the market overvalued? The interesting thing is that when I actually break it down and look at things like book price to book ratio, you see that Nigerian banks remain relatively undervalued. We are currently at 0.5 times price to book value compared to the African and BRICS peers. African comparable banks are 1.2 times price to book ratio, and the BRICS are also at 1.2 times. So yes, Nigerian banks have enjoyed a recent renaissance in terms of the market this year. And I think the low yield environment has also supported. So Nigerian banks did have good valuation comparisons when you look at them overall and stepping outside of Nigeria itself.
Okay, Nigeria is not alone in a recession. In fact, the global economy is in recession. Now, the Nigerian government is optimistic this recession will not last beyond first quarter of next year. Do you share the same optimism? What's your own projection?
Yeah, interestingly, we saw that the IMF in their half-year numbers were projecting minus 4.3% contraction for Nigeria for 2020. We have reviewed that in the context of the statistics that has been published since September this year, and our own estimate is something like minus 2.9% contraction. We're projecting into next year that the economy should be up 2.5% positive growth. So that shows you that we have managed to kind of take the punch from COVID-19 much better than expected. And yeah, we're in alignment with the government to say that we should see positive trajectory throughout 2021, particularly as you know that the fact that there's a vaccine exists for COVID-19 will mean that Western economies will begin to, recover more quickly. We continue to introduce more loosening, all these lockdowns as a result of COVID-19. Once the economy begins to move more to normalcy, then that would also help to propel the Nigerian economy. So we are constructive that we should see a recovery, just like the government is predicted in Q1 and Q2 next year.
Okay, so what about the banking sector? What is your outlook?
Our outlook, like I said, this year we think it's going to remain flat. Into next year, we think that they would also, being a barometer to the rest of the economy, we'll begin to see a quick recovery as well. Already you can see in the last quarter of the year, the Nigerian economy is picking up. We think that we might actually end this quarter somewhat flat from a GDP growth point of view. So, but the banks would always have that information ahead of most industries, and so they would have felt that impact. So we think next year will be much more positive for Nigerian banks. But issues as to the context of the industry remain. There are now 28 banks across different tiers, from the internationally licensed banks to nationals, to merchant banks, to regional banks, and to even the specialized banks. And so there's more competition. And you also have to remember that the fintechs are not resting on their laurels, and the fintechs are also attacking the same space that Nigerian banks are operating in. So we think it's further more challenging for everyone. But we think on balance that the big players will survive.
We hope for the best. Chioke, Group Managing Director, AfriInvest, West Africa. Thank you very much for your time. We do appreciate it.
Always a pleasure. Thank you, Chimezi.